Hey, good morning, everyone. Marty Missouri here, 4th of March, 2022, Friday, with your weekly macro update. Going to do the usual, talk a little bit about how our index just scored, and then take you through a handful of the inputs. This will be the last communication on the blog, I assume, from me until the latter part of next week. We're going on the annual ski trip that we go on, which means Nick, Ryan, and myself will be out of the office. Of course, I will be connected, so laptops and internet connections and so forth. So it could be that I do step in and offer up some commentary if I see something I think I'd like to offer my perspective on that I think would be useful for you, particularly clients, but clients and subscribers. As you've noticed for sure, the world's in quite the tumultuous place right here with the happenings in Europe. And it's having a not small impact on markets. Commodities have been on quite the tear higher. Of course, that's been very good for us to offset the decline in the equity markets. Plus, the hedges, and again, I must always remind you that the put hedges are generally there to mitigate major declines. We will always capture within our stock portfolios, the smaller to moderate declines. And we would define those as, mid-single digit to, the teens in terms of percentage, say for the S&P. Having said that, we did tighten up our hedge on our developed market foreign exposure, and that's obviously worked out beautifully. In fact, at the moment, as I start to record this today as an example, we're taking hit in our European exposure, and our Asian exposure is roughly on a par with what's going on in the US. Our hedge, it has mitigated more than half of today's decline. So that really helps on our relative performance. Of course, it'll work the other way when these markets come bounding back. And it's a when, it's not an if. The question is, how low do they go, right, before they come bounding back? Our SPX, or S&P 500 hedge, it's actually seeing a pretty nice pop today, but it's still a ways further out of the money, meaning the strike price on the put options several hundred points below where the S&P currently trades. And again, that's that mitigating the big moves. That way it keeps the hedging cheap and it keeps it pertinent. Again, we don't want to live in some fantasy world where we believe we can make above inflation returns over the long term without having periods of notable drawdowns. It's those monster 2008, early 2000s, spring of 2020 declines that we want to really be tactically mitigating and put in a position to take advantage of them when it's our view that they've indeed bottomed for good. In addition to that, we're hedging our commodities exposure as well. These great gains that we're seeing in much of the commodities exposure we have will be given back to some extent, over the coming weeks and months. But long term, our thesis, before this Russia-Ukraine situation developed, is higher inflation and higher commodity prices. What happens when we have these events is that it can exacerbate the upside and concentrate those gains over a very short period of time. And then before I run through the charts, just to repeat what I've been repeating almost every day, we have a situation where the real juice to the market, that has been in this nice big punch bowl, so to speak, that the Fed has provided to stocks, this liquidity, is being pulled. It's being pulled because inflation is really doing a number on people's lives. At the same time, as you'll see here, we have economic conditions that are actually slowing. You tend not to want to tighten financial conditions into a slowing economy, but you've got this real big inflation threat. And it's just being exacerbated by a situation that would typically add more weight, create more slowing of economic activity, and that's the geopolitical situation we're dealing with. So what a conundrum the Fed finds itself in. Typically, when these kinds of events would create such fear that the Federal Reserve wouldn't even dream of tightening monetary policy, reducing its balance sheet, raising interest rates, and so on. But there's that inflation problem. In fact, people continue to feel confident enough to quit their jobs at a relatively high pace, which means they have better things in the offing. When you read through the purchasing managers indexes, and I may share with you some of the services ISM PMI that just came out, businesses are having to continue to raise wages in order to attract people, and higher wages are inflationary almost by definition. They're the stickiest thing, meaning employers tend not to cut wages, right, even when times are tough. And you have to find the avenues to offset that either through higher productivity or passing that through to the end consumer. And that's what's been happening of late. And there's nothing in the surveys that says that's going to let up. And I suspect it won't until the economy is such that consumers just absolutely draw in and stop spending money. So what a conundrum the Federal Reserve has in front of it. What a challenge we have as portfolio managers. We do see, and I mean it, real opportunity, long-term opportunity in the stuff that's been working, and that's commodities. And in other areas that are working, like our Latin American exposure has been great so far this year, right? And that's, of course, a commodity-centric part of the world as well. We're seeing in many places different general condition setups for sure. I mean, China, for example, is now easing monetary policy while also engaging in some fiscal stimulus as well. The U.S. is having a tough time passing any more fiscal stimulus. Of course, we know they've done their fair share and a bunch up to this point. And that liquidity is still in the economy until the Fed begins trying to suck some of it out. So we do have different setups in different places. We have a situation again with our emerging markets exposure, which isn't small, where much of the areas covered there have been tightening monetary policy, and they'll be in a position to loosen, and they have interest rates high enough to where they can really do something, in terms of lowering them, unlike the US and Europe and Japan, for example. So let's jump through the hoops here with our index. Down 2 points again this week to 18.75. Still a comfortable gap between here and recessionary conditions, but still, slowing conditions by our measure. In the interest of your time, I'm not going to do a lot of elaboration on each one of these. We'll just look at them. I will elaborate, on things like the Purchasing Managers Index, but some of these numbers are going to be very noisy as bottlenecks ease and, and Omicron continues to ease and that sort of thing. So U.S. auto sales did tick down. Mortgage purchase applications down now for the fourth week in a row. I think the average 30-year mortgage is at 4.15%. The jobs number, which came out this morning, was a couple 100,000 better than expected at 678,000. Unemployment rate dropped all the way down to 3.8%. Average hourly earnings were pretty flat. The quits rate comes out at a different time. That's high when people feel confident. Job openings are incredible at roughly 11 million. Labor force participation rate picked up 10 basis points. And the U6, which captures part-time and people who would prefer to work more hours, actually ticked up to 7.20%. Some call that, the true unemployment rate. So folks, I can get into more of the weeds, but there's nothing concerning about these jobs numbers. The Institute for Supply Management surveys, the manufacturing survey, which again, that's the purple one, which we touched on already this week, actually ticked up a bit, but the services index dropped 3 full points to 56.50. I think I'll just pull that over and just touch on a couple of areas there with you to give you some of that texture. So when you break this down by sections, right? You've got the overall services PMI, which dropped to 56.5. So that's the overall score. That means the service economy is still growing, but at a slowing pace. And that's been the trend for the last 21 months. Business activity / production dropped to 55.1 from 59.9. Still growing, but at a slower pace. New orders dropped as well. Still growing, but at a slowing pace. Employment actually contracted. So the employment component actually declined, and it was growing previously. Supplier deliveries slowing now at a faster pace. inventory is actually growing, which makes some sense given what we've just experienced, right? So companies now are realizing that the real-time inventory situation, because of technology and delivery speed and so forth, can be tough at times. So we probably will see companies holding more inventory as a rule going forward than they have in previous years. Prices continuing to increase and at a faster pace. Backlog of orders, right, continuing to grow at a faster pace. New orders are now growing, and they were contracting in the previous month, so that's good. Imports growing at a faster pace. Inventory sentiment is now considered too high from too low previously. Overall economy, again, growing slower for the last 21 months. Service sector growing slower for the last 21 months. And then it's always good to look at what respondents are saying. I often copy and paste these onto the written blog. This one in particular from Professional Science and Technical Services is worth reading. Again, staff shortages, supply chain disruptions, and rising inflation continue to impact the world economy. Companies are struggling to hire direct employees and non-employee labor because wages continue to increase for both. The Great Resignation is real. Employees, contractors, and consultants continue to quit their jobs and engagements for opportunities that pay more and have more flexible work options. Millions of light industrial jobs remain open in the U.S. with limited interest from job seekers. Severe labor shortages are expected well into 2022. Here's the point I made earlier. Corporations need to increase wages and salaries to attract talent and to get work done. And then I concur, as I said earlier, faster wage growth is expected to lead to increased inflation. On a positive note, heavy truck sales improved, came back a bit month over month. The JP Morgan Global PMI Index 51.1, again, that's still expansionary. Below 50 is where you now have recessionary conditions, but again, not the kind of trend you'd hope to see in terms of global macro conditions. And then the Bloomberg Commodity Index, wow. I mean, we've been looking at this chart. I think last week we were looking at something about right here, an absolute explosion higher. Again, we have very high expectations. We're in that commodity supercycle camp, so we think there's more to go here, but absolutely unequivocally, we're going to get a choppy period here going forward. How high this goes before that chop begins, of course, remains to be seen, and we're hedging some of that commodity exposure because we do think there could be some notable downside as, again, some of these inflation pressures abate a bit. So much of it depends right now on what goes on in Europe. If I had to say what am I most bullish on going forward, probably copper, frankly, long term, given its ubiquitous nature in everything construction and everything renewable energy and so on. But as you can see, we're pushing again up to these all-time highs. And if there's one area that could actually break out and leave all this behind, it would be copper, but I expect we'll see some real downside volatility here as well. But the miners in particular look very attractive to us, and we have exposure there as well. And then last but not least, the sector to S&P 500 ratios. Tech really underperforming the S&P 500 over the last month. Again, 100 would be matching the performance, so a 97 would be notably underperforming. Tech is going to be probably the most inflation-sensitive sector out there, and that's definitely showing up here of late. Financials, very cyclical, of course. So it's financials, you might say, are discounting a weaker economy, right, and lower inflation rates versus what tech may be discounting. So definitely some confusing signals when you look at those two. You go to consumer discretionary, way down relative to the S&P, again, more just recently. And that speaks to concerns over the economy and to consumers' willingness to spend on discretionary items. But then we get to materials, right? Materials notably outperforming, and they have been for most of the past month, the S&P 500. And that speaks probably to inflation as much as anything else. Same for energy in a huge way, of course, and we know what's going on there. And same for industrial stocks, right? And you could tie that to some degree to inflationary pressures as well. And then we get to the defensive sectors that tend to do well relative to the S&P when the economy isn't doing well, right? And that would be consumer staples, notably outperforming the S&P of late. It would also be utility stocks, notably outperforming of late as well. And it would be healthcare, outperforming the S&P of late as well. So here I just showed you materials, energy, and industrials outperforming, which typically would say very good things about the economy. In this case, it says more about inflation. And then you have the three defensive sectors that I just featured would typically be underperforming the S&P during really good economic conditions, right? But they're not, they're actually outperforming. So that's, that provokes worry about economic conditions. That's that potential for stagflation, a slowing, stagnating economy amid a high inflationary backdrop. So folks, having said all that, now we need to recognize though that while these sectors that I just showed you that outperformed the S&P 500 so far this year, with the exception of energy, they're all negative on the year. It's just that they're not negative to the extent that the S&P 500 is negative. So while, as I presented that, which was kind of your textbook presentation about signals from the different sectors and what they imply, when you think about the concentration of technology in the S&P 500 index, which is around 28% currently, that's a big, historically big allocation. It's comparable to what we had in 1999 before the tech mess happened. So with tech having such a negative experience so far this year, pulling down the S&P 500, you could argue that rather than saying that, these sectors are doing so well as the charts might imply, these ratio charts to the S&P 500, it's really more about the S&P 500 doing so poorly because tech is doing so poorly. Now again, underneath the surface, you still might say, well, yeah, but they are outperforming and they're not down as much, which means those implications are valid. And I think that's true, but I do think I need to very much acknowledge the fact that tech is taking such a beating. And we could argue that's because there's such inflationary worries and pressure in the market today that it is dragging down the S&P to a greater extent than it would have, say, a few years ago when tech was a much smaller component. And therefore, the other spaces look better than they might otherwise look under these current circumstances. So folks, with all of that, I'll leave it there. I know in many respects that presentation was probably as clear as mud, particularly the last part. But this is the world we live in. Very mixed signals out there. We're dealing with a geopolitical emergency that skews a lot of things. And keep in mind that the data that I just presented to you, virtually all of it was captured pre-Russia invasion of Ukraine, although it was certainly on the cusp when a lot of it was captured. So I think these fears were in, for example, these surveys like the ISMs that I mentioned, but not to the extent that it would be there today. So in the weeks to come, as this thing plays out, we'll get to see how it is affecting the data that instruct us in terms of how to view macro conditions and how to respond as things evolve and so on. So folks, I'll stop there. Again, I'm going to go silent probably for the next few days. Thank you as always for watching and listening, and I'll talk to you late next week. Take care. Bye-bye.